So how did you figure out real estate as investing as a career?
To one of my friends. He's like, check out this book. Uh, I took it with me. I was reading Rich Dad Poor Dad. So
How did you do it?
it took me about a year from the time that I landed in Phoenix to getting my first deal. So I was kind of working for free for about 4 or 5 different investors or agents.
How many properties you own? And I know you're in different markets. So you do long-term rentals, and then there's something else that you do.
We underwrite all of our deals with long term financing just to make sure that it makes sense.
How do you find your clients? Do I advertise on Zillow? What do I do to find my clients? How do you find them? Over the years, I'm sure you have learned a lot about real estate, right? And do's and don'ts. So can you share some of your biggest do's and don'ts for the audiences?
Oh, you want to hear about my failures, huh? All right. Um,
Well, it's not really about your failures, but it's more about how did you overcome those failures, right? We all have them. Hey there, and welcome to another episode of Bigger Life Podcast, where we dive into minds of real estate professionals who are living big lives through real estate. I'm your host, Ray Bansal, and today we have another special guest, someone who's not only seasoned in real estate as an investor, but also a prominent community leader. Please join me in welcoming Anson Young to the show.
Thanks for having me. This is great.
Hey, how are you?
I'm doing very well. It's a good Wednesday today, so we're doing
Hey, I
good.
like your studio. I like your background. This is
Thank you.
awesome.
Thank you.
So, for those who might not know just about you now, can you tell a little bit about your background and what you have been doing, and things like that?
Yeah, sure. So I live in Denver, Colorado, and my background, I started off in IT way back in the day. I was a network admin, systems admin, and then I got laid off and really didn't know what to do from there. And so stumbled kind of face first into real estate, and for better or worse, haven't really looked back since. I've been licensed just about as long as I've been investing. So I'm kind of leading that dual life as a agent slash investor, with most of my focus being on investing.
Awesome. You mentioned IT. That resonates with me. I'm from IT background myself. Awesome. So, I know IT is a tough world. Personally, doing that, right, with the uncertainty of the jobs and the market there. How did you I mean, usually people think about stocks. So how did you figure out real estate as investing as a career?
Yeah. So when I got laid off, I hadn't been in tech long enough to accrue anything in stock market. It was kind of right after high school, took a year of college, decided it wasn't really for me. So kind of fell into a job doing IT. I was there for about 4 years, and yeah, then when I get laid off, it was kind of just, I have no idea what I'm going to do. I could double down on IT, go get more certifications, go do that whole route. Until a friend of mine handed me pretty much the origin story of every real estate investor. He handed me Rich Dad Poor Dad right before I was going to move down to Phoenix for a couple years to be closer to my brother. They just had their first daughter, so me not having a job and my wife pretty much having a flexible job, we decided to go down to Phoenix for a couple years. And right before we did, it was one of those things where we were saying goodbye in a parking lot to one of my friends. He's like, check out this book. I took it with me, read it on the way down there. Literally, when it wasn't my turn to drive the moving van, I was reading Rich Dad Poor Dad. So when I landed in Phoenix, I pretty much decided, this real estate thing seems like it could be the answer to my problems of not being in control of my paycheck, my job, any of those things. Let me check out, what I can do with it.
The first time I read Rich Dad Poor Dad was in 2007 when I first moved to US from India.
Mm.
And my brother-in-law, he gave me that book. I read it and I could not make sense out of it because I'm thinking, I don't have a job. And at the time I was working in the mall making $10 an hour and buying homes and renting them out. I mean, I'm living in an apartment, paying like $900 per month,
Yeah.
and that did not make any sense to me. I was like, this is all crap. This cannot be done, or whatever. Fast forward to 2018 or 2018, and I read it again. By the time I got a little bit more stable job, got some savings, and stuff like that, and it all made sense. But
Yeah.
everyone that I have talked to, Rich Dad Poor Dad is a classic book for investors that pretty much everybody has read it. Everybody got inspired from it. It's an awesome, awesome book. If you guys have not read it and you're watching the show, please highly recommend it. Go ahead and read it. If it does not make any sense, just like I said, the first time it did not make any sense for me, reach out to myself or to Anson or somebody else who knows what they're doing, and they'll explain it to you what it meant.
Yeah, I have mixed feelings about that book now. Um, I have a couple copies of it just to give away here and there, but uh, it's really good on mindset of just like a change your mind, let you look down a different path that you may not have known existed, but like there's no like tactics in that book. It's pretty much all just philosophy of the mind, which is good. That's probably what it's meant for, but that's one of its biggest critiques that I get from people who read it are, well, that's great, but how do I do what's in here?
and that's
And
where
then
and that's where Bigger Life Podcast comes to the play, where you and I will talk about how to do it. Because once you got the mindset ready, that you're ready to do it, and now you're starting at asking the right question: how do I do it? And let me ask you that question: how did you do it?
how did I do it? So our my first deal was a live-in flip in Phoenix. It took me about a year from the time that I landed in Phoenix to getting my first deal, and that time was spent. Um, I was latching on to every investor and agent that I could network with, and just I was doing just crappy jobs for them in exchange to learn uh, pieces of real estate. So I'd go punch signs in yards for an agent, and she would teach me how to do comps on the MLS. And I'd go door knock for an investor, and he would teach me contracts. So I was kind of working for free for a lot of for about 4 or 5 different investors or agents, just to like really get that on the ground, you know, experience of the different pieces, filling in the gaps of what I didn't know. And believe me, I did not know anything. So starting from zero, um, I was trying to provide value in exchange for value. And so, I wasn't just going, hey, teach me MLS, teach me how to do comps. It was, I'll go do whatever you want me to do, and then teach me comps. So that live in flip was, it was turns out it was a wholesale deal from one of my agent's clients. He just wanted to get rid of it. We bought it, didn't really know what to do with it, honestly. Like it was one of those scatterbrain things where I had 10 different tactics in a folder, and I was like, I could lease option it, I could rent it, I could, it was just too much, until my wife was just basically like, why don't we just move into it, because we're renting, like 20 minutes away. Why don't we just move into it and then fix it up and then go from there? And it was like, okay. So we ended up doing exactly that. So moved into it, fixed it, sold it a year later, and that was kind of our origin journey.
Yeah, the good thing was you uh, put your networking in place beforehand, and you were learning from that. So kind of like an internship, right? So you were interning with
Mhm.
all these different sets of people, be it an agent, be it an investor, and everybody else. And now you have different ideas to, or sometimes you have more than one ideas, right? And you're like, okay, but you had people who could guide you and mentor you to say, okay, what can you do with this deal, and how you should be doing with this deal. So
Right.
the networking is important. So, awesome. So that was your first fix and flip. And what happens next?
So what happens next is we were, like I said, uh, we moved down to Phoenix to be close to family. My brother ended up having to take a job about a year and a half into us living there, and so he took a job in Ohio. And my wife and I just kind of looked at each other and were like, "Well, we have no real ties to Phoenix, and plus we both didn't really enjoy being there, so we're going to move back home." So we sold that flip, uh, packed up the moving truck and the dogs and moved back to Denver. And what I basically did was I got a job right away with like on a real estate team, and because I wanted to still be close to real estate, but I was nowhere near ready to go out on my own and uh, figure this out, without a safety net of some kind. Plus, Denver, I grew up here, but that doesn't mean I know anything about the market. So I felt like I was starting all over of learning the market. The market was changing. This was 2006. Uh, so Phoenix was already starting to uh, kind of cool off and start on that trajectory towards 2008. And so, I got a job with an agent to be closer, to keep close to real estate. And I ended up doing my first flip probably about a year later here in town. And then from there, that was a partnership with another agent. In the meantime, I got my license. So I've been doing some license stuff. And from there, we just kept flipping. And then we didn't have a ton of money. And so any deals that we got that we couldn't flip, we would just wholesale. So from there, basically, I had been flipping and wholesaling, you know, for for pretty much 12 or 13 years until I kind of switched strategy a couple of years ago.
Awesome. Yep. So being the takeaway from this is being within the network of the people that the kind of work that you want to do is important. Because that's how you're learning, and while you were making the money and you were learning and you had all these connections or the network of people that you're establishing side by side. Right. Awesome. So fast forward today, how many properties you own? And I know you're in different markets. What are your markets that you're in?
Yeah, so we switched strategy from just doing those transactional deals to now we do BRRRR deals. So like you said, we're now accumulating properties, but we're in since Denver is a high cost of living market and cash flow is pretty sparse here. We did start buying in Nebraska, so Omaha area, and then also in Ohio, in Cincinnati and Columbus. And so between those three markets, there's about 35 properties in the last 3 years. Is what we're doing.
Awesome. Walk us through those markets. Like, what's the average deal size that you're buying? How are the numbers making sense over there? So let's take Nebraska first of
Mhm.
all, and then we'll go to the different markets. Why Nebraska? What kind of
Uh,
numbers do you see, and what kind of returns do you see for yourself?
yeah, Omaha's close to what Denver was doing about 10 years ago. I honestly wish that I would have like gone over to Omaha and Kansas City about 5, 6, 7 years ago. It would have been really like kind of before they started popping. Um, but in Omaha and in the area, they just have really good strong numbers on population, on job growth, rent to rent to price ratio. All of those numbers really make sense. And then being able to compete in those markets was another metric that I had was, can we go into a market and actually buy, you know, the amount of deals that we need to buy, which is probably about, 10 to 15 a year, um, if not more. We're still wholesaling deals, extra leads and stuff that we don't keep. And so, it has to be a robust enough market to be able to do all that. And the numbers, roughly, 1% still exists out there for long-term rental. So if you buy at, if you're all into a property at 125, it'll rent for, 1,025, per month basically. And so, um, or 1,250, I should say. Uh, and so the 1% rule on those long-term rentals is still, it still exists there. So it's a good, it's a good market to be in uh, for those baseline long-term rentals.
So is the average deal size like a three to like 125, $140,000 over there?
Yeah, 125 to
And
175 in that
if you
range.
buy
Yeah.
it that means do you still have to do the BRRRR on it or and spend that additional capital on it, or that's pretty much done deal, like ready
That's
to rent?
Yeah, that would be the all-in price. So we still do value add burr. So we'd probably buy it at 75, you know, put in 50, and then it's worth one, and then we have 125 all in, and it'll probably appraise for the 175 range on a deal like that.
Awesome. So how are you financing your deals since you're buying quite a lot, right? So how are
Yeah.
you financing your deals?
So hard money and private money is how we're doing the acquisition and the repairs. So that's one loan, and then we're refinancing out into DSCR or portfolio loan when we're ready. When it's all fixed up and ready to be when it's rented and ready to be refinanced out.
So for the newbies who don't know a lot of this terminology, let's kind of dig deeper. So let's say you got a property that and let's take a realistic example, and correct me if I'm wrong. So average property that you're buying is what, $80,000,
Hmm.
and it needs another $50,000 to repair it up, like, right? So that's roughly like 130 all in.
Hmm. Yeah,
And
that's about right.
then, yeah. So where do you bring that first 80,000? And so walk us through that. You use the terminology, I know the terminology, but for the viewers, right? So how are you financing it for
Yep.
the purchase? And then how are you financing it for the repair it? And then you said appraisal and refi, DSCR. Walk us through each of those steps. So how to do it?
So on the purchase, we're approaching a hard money lender. Let's just keep it easy. Let's just keep it in the hard money realm. Approaching a hard money lender, showing them the deal, saying, like you said, it's about $75,000 purchase, $50,000 on the rehab, and so they're lending us that full 125,000, and we're coming in with about 10% down payment on that, and plus a couple points. So if you really want to get nitty gritty, it's about 11% APR or annual percentage rate, and between 1 and 2 points. So that's just 1% of the amount that you're borrowing as just a fee to the lender. So so that hard money lender will lend us the purchase and the rehab, both. And so when we go in, we just have to pay the 10% down payment on the total of those two loans. It's really one loan, but if you want to piece it out in your brain, that's totally fine too. So you have the purchase, you have the rehab, the lender is lending you all of it, and you just have a down payment on that full amount. And then you go to closing, and you're ready to get off to the races to fix the property. And most of them will do a draw system, so you'll pay out of pocket to start fixing the property, and then they pay you back at certain milestones. And then when you're ready, the property's fixed up. Uh, Most of the time, you have to get a renter in there. The lenders like to see that there's that there's a renter in place, and so you fix it up, get the renter in place. Now you approach a different lender. This would be, um, in our case, a DSCR lender, so a debt service lender who will look at the amount that it's rented for. Uh, and so if that property is rented for, big round numbers, let's just say 1,750 a month, they look at that and uh, they go, okay, well, so if it appraises for a certain amount, if it appraises for roughly 175, we can then get you get you all the way out of that hard money loan on a refinance. So then they're doing their appraisal, and of course we've done all these numbers up front, right? We're not just hoping that that appraisal, praying that it comes in at 175. We've done the upfront numbers to know that that's what it's going to be worth at the end, and barring the human element, it should come in close to that. So appraisal comes in, DSCR lender says everything else looks great. We then close. We close again. We go to a different closing, uh, and they will. We're usually doing a cash out refinance. So when I said that we put 10% down on that property, we're actually getting that money back at this second closing because it's a full BRRRR deal. We're refinancing on a cash out, and we're repeating. We're taking that same money, putting it down on the next property. So I might have missed a few pieces in there. You can tell me,
Yeah.
but in a nutshell,
Yeah. So in a nutshell, what this deal is, so it's BRRRR. BRRRR stands for buy, rehab, rent, refinance, and the last piece is repeat. So
right,
what essentially you have done is, so you have no skin in the game by the time you do a second one. All you're left with is the equity. Now you have sweat equity in there, right? So what you did was you put all these pieces together. So there's work and there's risk involved into this. So don't assume there's no risk. There's risk, but that's the reward, and that's a calculated risk. That after you do so many deals, then you know your numbers. And once you know your numbers, basically with the second refinance with the DSCR loan, what Anson is able to do is he's able to pay back the hard money, the private money lenders, as well as his money that he put contributed like 10 or 12%, the upfront cost or some of the soft costs that he has to pay. So roughly when you're able to refinance the second one, roughly you have no money into that property. Everybody is paid off, and now whatever rent you're collecting minus your payments, the mortgage payment, other expenses, and whatever cash flow, the net cash flow you have, and that's positive cash flow. So in this process, what you are able to do is you are able to create equity and cash flow. And if you do it enough number of times each year into multiple deals, the same process, then the goal is that if let's say if you accumulate 100 properties and every property, let's say, is producing $200 positive net cash flow times 100, do the math, plus all the equity. So 20, 25% equity into that. And by the way, your lending cost will go a little bit lower because when you go to your lender for the first deal, they don't know you, they don't trust you, it's going to be at a higher cost. But by the time you do your 10th, 12th, 15th, 20th deal, they know you. They want to give you their money, right? They're like, hey, Anson, when are you doing next? Right?
yeah,
So,
that's true. That is
uh,
true.
yeah. All right. This is good. Now, with these properties, and I know we talked about that, right? So you do long term rentals, and then there's something else that you do.
Yeah, so we underwrite all of our deals with long term financing just to make sure that it makes sense. Kind of worst case scenario, like if the worst case scenario is we get 1750 for rent, does this deal still make sense? It has to be a yes, otherwise we don't do it. Um, from there, we'll try to maximize cash flow on pretty much every deal. So for us, you know the kind of really good middle ground is a midterm rental, which is just a rental that's over 30 days, but usually less than a year. It's short term rentals are mainly under 30-day leases. Long term rentals are usually a year lease. So on the midterm, you're furnishing the property, you're putting in all the furniture, uh, you're listing it as just bring a suitcase, come to town for a month and rent this place. And the benefits are that you're actually getting more in rent than you would on a long term, uh, and less than a short term, but there's a lot less turnover than a short term rental. So that's the main method that we're doing for most of these deals.
Yeah, the benefit of midterm rental is twofold. One, it's kind of like short term, but it's not short term. So it's furnished rental to begin with. The cash flow is higher. However, the it's a middle ground, right? So the cities and the jurisdictions that does not allow short-term rentals, they have to allow midterm rental because technically it's a lease. There's 30 days over, so you have a tenant in there, you don't have a guest in there.
Right. Yeah, exactly. And it's our way of, we haven't been in any market where short-term rentals have just gone away. Like Denver has some pretty tight restrictions on short-term rentals, but midterm is kind of just open, like open season. So we figured, without having to do the high turnover, it's definitely harder to do when you're remote. You're managing property management and uh and potentially like cleaners who have to go in there every 2 to 3 days. Um, that's just intensive. So on a midterm rental, we're getting the benefit of the higher cash flow, but our turnover is every 1 to 2 months instead of every 2 to 3 days. Which talking to some short-term rental investors here in town, they're like 1.6 days is their average turnaround. That means that every 1.6 days there's laundry and you know turnover, cleaners, everybody going into the property every other day. On properties that you own that are thousands of miles away, it's a lot better peace of mind if those are turning over every month or two instead of every 3 days. To have a problem come up would be
Well, plus, if
stressful.
you're doing it for 30 properties, it's easier to manage, let's say, from a total rental standpoint. If I'm doing two, three properties, but the moment you scale 30 some properties, then you are constantly busy chasing these cleaners and housekeeping and this and that. Versus with midterm rental, it's not as much. So
Exactly.
not only the money part, but it's also the management and you just get sick and tired. I mean, it becomes another business rather than investing.
Yeah. Yeah, exactly. Yeah, I don't want to manage teams of cleaners. So
No. Now, this leads into midterm rental. Let's go a little bit more deeper into that. How do you find your clients? Do I advertise on Zillow? What do I do to find my clients? How do you find them?
to find those renters, so for midterm rental, furnishfinder.com is really good. And midterm, we found that verbo.com is also really good. If you're putting in leases there that are over 30 days, we're getting a good mix of both of those sites. Furnish Finder is great for, the traditional uh, traveling contractors, traveling nurses, grandparents in town who need a place to stay for 1 or 2 months. Verbo is good for those people as well, but also caters to people who are also um, kind of wanting to take a longer term vacation. Like, if they want to go, you know, be close to their kids who are in college for 2 months, they would rent, uh, a house like one of ours in Lincoln, Nebraska, that kind of thing.
Yeah. And between the two sites, have you had any, do you prefer something? Is there any extra strategy that you use for Verbo or so how are you doing it? Because Furnish Finder is for like, they started off with traveling nurses and stuff. Now a lot more professionals are on there. But Verbo basically mostly has been used by short-term rentals. But you, I'm sure, have some kind of a different strategy to use Verbo for your midterm.
Yeah, so my friend Dan does Verbo here in north of Denver, and talking to him, he really enjoys it because he's basically Airbnb's the big dog. Verbo is definitely a smaller platform, but he found that he could perform really well. If anybody was searching in you know that northern Colorado, like just north of Denver sector, on Verbo, his would pop up, pretty much top three. Because it is a smaller platform, if you can get your reviews and if you can get, all of the metrics that you need up and running, you will stand out on that smaller platform much easier than having to get 1,000 reviews on Airbnb to pop up in, Omaha, Nebraska as part of the top 10, that's a whole different story than trying to be like top 10 on a smaller platform. And, and I agree with him. He had told me that the kind of quality of the tenant is a bit higher. No, I haven't had any issues with like parties and wedding parties coming to town and just like trashing our house or anything like that. So it seems like the clientele is just geared a little bit more differently than the Airbnb clientele. And between that and it being you being able to stand out on the platform a little bit easier, between those two things, I'm really in favor for it for midterm rental. I have no complaints on it at all.
Yeah, I agree with you on the quality of the clients that you find on Vrbo versus Airbnb versus their other channels like Booking.com and Expedia, and then a few more. Every every channel, as they call it, every channel have a kind of like a clientele, and Vrbo clientele is usually much experienced, professional, and they're just better. Whereas Airbnb is more, they're like fast moving, like fast moving consumer goods, right? So
Totally.
yeah, much more over there. Between the three markets that you operate in, do you have a preference for any market, or they're kind of behaving the same?
They're mostly behaving the same because the metrics are pretty similar. Uh, that was, that was obviously important going into it, was choosing some markets where all of the things that are important to me are exist in those markets. So they're going to have a lot of similarities. Columbus is interesting because there's a lot of interesting things happening on like the east side of town where, there's a new, um, like silicon chip factory that's going in, as that was announced I think 2.5 or 3 years ago. They're trying to onboard and bring in more American manufacturing for silicon chips for everything, like even like seat warmers in your car. Like we had the big chip shortage a few years ago, and as part of that they're trying to bring some of that manufacturing to the US. And so they're building this $1 billion plant on the east side of Columbus. And so there's, that area is hot. It's very good time to be into that area of the market. I really like Lincoln, Nebraska. It's a little bit smaller. It's just about 30 minutes or 20 minutes from Omaha, so I kind of like lump them together. It's smaller. It's about 250,000 in that town. It's a college town, but it also has, it also has its own industrial sectors, job sectors, and proximity to Omaha, which is, I think it's like the largest concentration of billionaires or something in the U.S. Not that that matters to us because we're not renting to billionaires or anything, but like, there's just there's jobs there. There's population growth. There's the houses are appreciating, the rent to price ratio are all really good, and each market has kind of its own specific thing going on. uh there's no chip factories being built in Lincoln, but there's a college there that's not going anywhere. And so there's a lot of different variety of factors that make each one great, but it's good to be in different markets where you're not just have all your eggs in the Smoky Mountains or into those one baskets where if something goes wrong in that market or a wildfire comes through, flooding, whatever that looks like, it's like wipe out your whole portfolio. If you diversify a little bit, I can sleep better at night usually.
So with your portfolio growing, with right now you said about what 30 units. What's your revenue? What's your cash flow? So give us a little vision on that.
Like I said, we're trying to maximize cash flow um, on each property. So on long term rents, we'd probably be looking at that two to $300 a month range in cash flow, and instead we're seeing roughly about 1,000 per property. Um, So if you do the math times 35 properties, that's roughly our monthly cash flow from those deals. So midterm rental obviously doing a lot of the heavy lifting there, bringing us like 3x the cash flow profit that we would get uh, from long term rental.
Yeah. But how much are you into midterm rental versus like that you have a portfolio of 30 properties? You got a 50-50 mix, or is it like mostly midterm, mostly long term?
It's probably like a 70-30, so 70% midterm, 30% long term. It was 50-50 up until uh, the beginning of last year, and then we really just pushed hard on the midterm, uh, and uh, and it's obviously paid off. Like yes, you have to furnish those properties, and yes, there's more turnover than a year long lease, but the 3x on cash flow profit is worth it.
Yeah,
And to an average, I think some of them are like uh, are much higher than that. So
yeah, it totally makes sense. And once you have enough units into a particular area, then even those midterm rental guests who are coming in, and they are corporations who are looking for their people, or whatsoever, and they either have additional need, or they have a need next time. They know you, they know your unit, right?
yeah, yeah,
They know the hospitality and the kind of maintenance that you're providing, so they like that kind of a relationship as well.
yeah, totally. And there's a bunch of different niches you can get into. One is like uh, property restoration or insurance. So people who did have like a house fire or a flood, like usually they need like really quick placements, and they're paying pretty much as you would get for a midterm rental, if not higher, for that, 2 or 3 months till their house gets fixed up and they can go back in. You're getting paid by the insurance company. So it's very stable. And there's a bunch of different niches that you can get into even inside of this one real estate investing niche. There's 100 different ways to skin this cat. So yeah.
Now, are you doing something specifically for those insurance clients, or pretty much Furnish Finder and Verbo, and they just find you? Because there's two ways that you can go about it. Either you are like, I'm on Furnish Finder, I'm on Verbo, let them find me,
Yeah.
or I know certain people who kind of penetrate deep into that insurance market. They kind of establish that relationship, so they kind of get the first call. So,
Yeah.
which one are you?
We're mostly on the first one and trying to get in more on the second side. So being able to like provide, safe housing for somebody who's gone through something, crazy like they have, and is is it's gratifying to be able to provide housing for people who need it, and at the same time being on that first call or second call. So we're talking more with the people that we've been lucky enough to work with, to be able to get in more with them to help them help their clients.
Now, a lot is changing in the economy, right? So we are recording this episode early 25.
Mhm.
Uh, New administration is going to come in. The interest rates are still kind of high. The economy is what it is. What's your outlook for real estate as Anson? And then also as a new investor, what should I do? Should I be sitting on the fence? Should I take action? Should I just wait for the interest rates to come down? What should I be doing? I mean, can you share some thoughts on that?
Yeah. So let me grab my crystal ball and no. So it's it's obviously hard to say what's going to happen, but I'll tell you what we're gonna be doing. We have really no plans to change what we've done for the last 2 years. Coming up into this year, we're actually going to probably be buying more, um, and moving into one more market this year. And I think, having gone through, I've been investing since 2005. So going through, the 2008 kind of crash, mortgage crisis, subprime crisis, all that, all the way through doing uh, a few hundred short sales. After that, everybody, got lifted up by the market, and then going through the craziness uh, of of COVID and lockdowns, and houses just spiking through that. We're not we're not scared of interest rates. We're not scared of administrations. There's really not much that could be done, to keep us from buying another, 30 properties this year, or more, and wholesaling another, 30 to 40 properties on top of that. There's really nothing inside of those markets, or nothing that's going to change, what we're doing. If the deals are working, they're working. We're not in multi-million dollar markets. We're talking about $100,000 to $200,000 houses at 7% or 8% interest. And if interest rates go up, we won because we locked in. If interest rates go down, we won because we can refinance. And so I'm not too worried about those things. I can't see any, you know, market factors that'll keep us or slow us down from just what we've been doing for the last 2.5 years or so. We're just going to keep chugging along. And so, as a new investor, yes, the market's completely different than it was 4 years ago. Interest rates are a lot higher, but there's still deals out there. If you can still underwrite deals and make them work, you don't want to be 10, 15 years down the road kicking yourself for sitting on the fence. Like, why didn't I get into it in 2025? Every year we have the same conversation where people are like, oh, it's too late, I missed the bus, I missed the boat, the train left the station without me. People have been saying that about real estate since recorded history, I'm sure. But like, even in just America, I'm sure that there's somebody who's like, oh, I wish I bought in 1878. My steamship has sailed. It's like, no, there's always opportunity. If you know how to find deals, you'll always be able to make it in real estate, no matter if it's 18% interest like we had in the 80s. There were still people buying during that time. Rate or houses were going up in cost, and interest rates were 18%. There's still investors who are buying all day long. And I'm sure even 10 years later, they wish that they bought more, because the interest rates did eventually come down and the prices kept going up. So I I'm very like bullish on this stuff. So like, if or if you are like on the fence, it's not too late. You haven't missed the bus. 2025, that's your year. Let's go.
Yeah. Every day, every moment is your time to catch the bus, because every time frame or every year or whatever you want to say it, you just have a different prompt, right? The market is different. In 2021, the interest rates were low, but there was so much competition. For each home, you had like 100 offers, 150 offers. Now the interest rates are high, but you have a different prompt, right?
Yeah.
So you just have to work through that time frame and look at, okay, what with the changing market dynamics, how can I invest? You just have to change your strategy and look at things differently. But in every market, as you rightly said, right from 1800s to today, in every market you can invest, you can still make money, and if you are not cautious enough, maybe you can lose money. Doesn't matter which market you're in.
Yeah.
So you just have to underwrite your deals. You just need to know what you're doing, and if you're doing it the right way, you'll in the process you'll make money. And guess what? You're not doing 30 deals like day one. You're doing a deal at a time.
Mhm.
So that
Yeah.
way, my first deal, did it work? What are mistakes I made? What's my learning curve? And improve on the next one, and then improve on the next one, and then improve on the next one. Right.
Yeah. Absolutely.
So I know you are exploring some new markets.
Mhm.
What are the other markets that you're excited about, and why?
So the why will kind of push the first question, but like, so for me on a 15 or 20 year outlook on deal, like, what is the market going to be doing? What is the what are the conditions going to be like in 20 years? I'm trying to think of not just having like a 3 year let's make quick money forecast. Like I want to be like in this market for a long time, and so we're kind of looking around and seeing what's going on in like the southeast and the South Texas markets like that. You know the I think it's like 4 or 5 summers in a row where it's like the hottest on record. So it's like for me, climates is pushing me in a certain direction, and there's two fronts there. One is like, what's going to be a stable climate that's not going to push people out um, of this area, and then also being from Denver, being from the West, and growing up my whole life in the West, we have water problems out here. It's like Denver, not so much, but if you're in Phoenix, Vegas, uh, parts of Utah, parts of California, we there's a definite um, populations like too big for the amount of water that they need, and so putting those two things into a factor, I'm looking into the Great Lakes areas, where the climate is predicted to be stable and not push people out with giant weather swings. And then obviously access to fresh water. They have no problem with that at all. And plus that, and you have to factor in the other things that we talked about earlier, which is, crime rate and population growth and jobs and, price to rent ratio and all of those things. There's probably 30 to 40 markets, in the Great Lakes area, whether it's Wisconsin, Illinois, Ohio, Michigan, New York. There's probably 30 markets in there that we could land in, but we're in the process of kind of whittling down, where that looks like. So, but long story long, that's kind of what we're looking at, and why.
Over the years, I'm sure you have learned a lot about real estate, right? And do's and don'ts. So can you share some of your biggest do's and don'ts for the audiences?
Oh, you want to hear about my failures, huh? All right. Um,
Well, it's not really about your failures, but it's more about how did you overcome those failures, right? We all have those.
yeah, yeah,
And if we don't have those, I think we haven't learned.
yeah. No, I learned a lesson. I first heard about the lesson and then I learned it in person. Um, I had I was trying to do a deal with Jay Scott, who's another Bigger Pockets author. He wrote a book on flipping houses and book on negotiating real estate, and I think three or four others. But like, this is probably like, I don't know, it's probably 10 years ago now. But um, he was based in Atlanta at the time, um, and I had found some REO deals in Atlanta, and I was shopping them to him. I just said, hey, you're doing some flips down there. I found some REO deals. If I could make a couple thousand off of them, great, and you can have more inventory for your business. Um, and I remember him going through one of the properties, and uh, there was like a beam or something that was um, that just needed more repair than he had budgeted for. So at the end of the day, his offer was about $500 off of of what I was offering the property at. And at the time I was just like who cares? Like it's $500. Like just eat it, or like there's got to be room in this deal. Like you probably have 30, $40,000, budgeted for profit. And I remember him just being like, no, if you move your goalposts, or if you open up your buy box in this one deal and you kind of loosen your guidelines on this one, you're just gonna like keep doing that. And then the next one will be like, oh, this one's $1,500 off. And the next thing you know, you're like taking on deals that are so far outside of your like business buy box that you're just gonna get yourself in trouble. And at the time, I kind of like dismissed it. I was like, oh, Jay's just being like extremely conservative about this. Um, we ended up not doing the deal because it would have been negative. Like I got down to the property where I was losing money. Like I would have lost the $500. Probably would have been worth it just to do another deal with Jay. But I ended up we canceled. We parted ways as friends. And it wasn't till like 3 or 4 years later till I did that where I'm looking at a deal. I don't touch structural deals. Um, I just like as an agent and as an investor, there's just a stigma and disclose like even if you disclose everything and if everything was fixed, there's still like a stigma that buyers have on scary structural. It's like the worst thing possible that can happen to a property. And so I was a little like hard up for a deal. It had been kind of a slow quarter. I got presented a deal where it was the structural bid was in place. All the rest of the property was great, just needed a little bit of cosmetics here and there. So on paper, it's a great deal. I broke my buy box. I went outside my buy box to get this structural deal, and it was kind of like two or three things happened that were related to the structural where like they couldn't lift the house uh, as much as they had promised, and so there was still a noticeable slope when you're walking in the house, which is not great, by the way, when you're trying to sell a flip. People kind of like straight level houses, and so and then the basement flooded while it was listed as well, which is not really related to structural, but it kind of just ate into what was already a thin deal. It was like okay, it was an okay deal. And between those two things and it sitting on the market for 6 months, which is roughly, I think it was twice the amount of time that we had budgeted for because of the structural. Um, we lost. It was one of the only like two or three deals that we've ever lost money on, and it was just like one of those things where I'm like, oh, Jay was right. Like you have your box for a reason, and if you go outside of it for dumb reasons, for reasons of like I need to do this deal or um, whatever those reasons are, the next one you could see yourself kind of shimmying and opening up your buy box a little bit, and yeah, structural deals are fine, and there's calculated ways to do all of that. But I just remember like learning that lesson, not paying attention to it, and then later on learning that lesson by having to write a check for like 30 grand at closing in order to close a property that I'm trying to flip. So I lost, you know, I lost 30 grand on that property, and it taught me, oh, this is why I stay inside my buy box and take on deals that don't have structural. So that's kind of like a two-part story of me ignoring a lesson and then learning it later on and going, oh, like Jay was right the whole time.
It's a good lesson. Even I kind of learned from it because
Yeah.
it's a good, inspiring story. Because yeah, structurals. I don't think I have bought any structurals as of now, but I'll keep that in mind. Just avoid it. I mean, there's so much to deal with. Why should you deal with something that has been touched upon? There's no
Yeah.
reason. Yeah.
Yeah, exactly.
Alrighty. So for anyone who's there listening and wants to connect with you, how should they reach out to you?
Yeah, if you're on Bigger Pockets, just find me there. If you're on Instagram, I'm at Young Anson. I'm also on YouTube at Anson Young, or Facebook the same as well. So
Anson, thank you so much for joining us today and sharing all your wisdom. It's been
yeah,
amazing about your journey and insights into real estate.
thank you for having me. It's awesome.
For everyone listening, be sure to check out Anson's book, Finding and Funding Great Deals. And if you're in the Colorado area, definitely look up the Badass Real Estate Investors Meetup. Did I say it right?
You did, absolutely.
And for more episodes like this, subscribe to Bigger Life Podcast, and we'll catch you next time. Thank you again. Thanks, Anson.
Thank you.